Bitcoin is an existential threat to Wall Street, but the big banks like JP Morgan are not going down without a fight. What we're seeing between Wall Street giants and Bitcoin companies like Strategy and Strike is a battle royale for control of the monetary system that goes all the way up to President Trump himself. So pull up a ringside seat to the financial fight of the century. This is Simply Bitcoin's Satoshi. Let's go.
Operation Choke Point 2.0 has been so much bigger than many of us knew. So I was so glad that Mark Andreessen got on Joe Rogan's program and blew it up. And then you had all kinds of people who've been debanked get on X and explain what debanking has done to their businesses. It could be a gun manufacturer, it could be a marijuana business, it could be an oil and gas producer, and it's definitely been crypto assets. They have illegally, and I mean this government, our government has illegally gone after an industry and tried to snuff it out through the regulatory state, through the bureaucracy.
Senator Cynthia Lummis tweeted that Operation Choke Point 2.0 regrettably lives on in response to the latest developments in the war between the establishment and Bitcoin companies. It's basically monetary mean girls like the movie. And the bankers are telling the Bitcoiners that they can't sit with them.
So that's against the rules, and you can't sit with us. Whatever.
Chase debanked Strike CEO Jack Mallers without giving any other reason than concerning activity. Eric Trump recently described getting debanked because of his father's politics.
Not only was I debanked, so many people in this country were debanked, and every day, millions of people around the world are debanked for no reason whatsoever. I happened to be debanked because my father wore a hat that was red that said, "Make America Great Again." And I started getting letters. I got a letter from Capital One, effectively closing 300 of our corporate accounts. I got a letter from JP Morgan Chase, closing 52 of our corporate accounts. I got letters from Bank of America. These are the largest financial institutions on earth. Closing our accounts for no reason. These are golf courses. These are condominium associations. These are hotels. These are restaurants that we have in the portfolio. They didn't give a damn. They wanted to take the rails out from under us. They wanted to debank us. They wanted to deplatform us, and they wanted to hurt us. And I realized very quickly that the very same people who are coming after us, those banks were also going after people in cryptocurrency who just wanted to improve the system. Why is it that you can't send a wire transfer after 5 o'clock on a Friday afternoon, right? Now that makes complete sense to me as a business guy, right? JP Morgan wants to hold your money, for 72 hours over the course of a weekend. They want to take the interest associated with tens and tens of billions of dollars that are sitting in purgatory. Is that fair to the average consumer? And by the way, is that financial freedom? You literally can't move your money for a 48 or 72 hour period of time. It's insane. It's asinine, right? And so, in cryptocurrency, you can move unlimited amounts of money for virtually zero fees, no middleman, none of these crazy exorbitant banking fees at 11 o'clock on a Saturday, from your cell phone while having a glass of, wine with your husband or your wife. Isn't that financial freedom? Isn't that modern finance? Same thing. Try finance at home. You go through a process for 120 days and know your customer with a bank that you banked at for, 30 years. Does that seem current? Does that seem technologically advanced? It's not.
And Michael Saylor, executive chairman of Strategy, which holds the largest Bitcoin treasury of any public company in the world, finds himself in the crosshairs after JP Morgan noted that his ticker, MSCI, could be excluded from one of the largest stock indexes, effectively cutting off massive capital inflows and handicapping the stock price.
In Bitcoin specifically, you had the JP Morgan CEO and chairman, Jamie Dimon, calling it essentially pet rock, and once again calling into question its worth and its value here. I would love to get your reaction, especially as some of the financial industry elites and figureheads are continuing to cast some doubt here.
Yeah, thanks for having me, Brad. What do I think about Jeffrey Epstein's banker being concerned that a distributed, decentralized, open public money could potentially be used for bad things? Sitting on a ski resort in Davos? I don't really care. I don't know why anyone cares, right? I mean, that guy knows when money's used for bad things. So it's a weird opinion of his. And my pet rock was up, as you said, 160% last year. It performed well against the dollar. So I don't know. I don't really care what that guy has to say about Bitcoin. I don't know why anybody does.
Everyone remembers the infamous dump on October 10th. No bounce, just bad vibes and pain. Maximum pain. MSCI, the world's second biggest index company, quietly announced a review of Bitcoin-heavy companies like Saylor Strategy, MSCR. Basically, you bought too much Bitcoin and now you're not allowed to play with the big boys. The mean girls of TradFi finally realized that the new girl is actually pretty hot, but they're not gonna let her be queen bee so easily.
MSCI recently announced that they are evaluating whether Bitcoin treasury companies that hold more than 50% of their balance sheet in Bitcoin should be removed from their indexes. It is essential that this decision is made correctly, because the logic behind removal rests on a misunderstanding of what these companies actually are. The argument is if a company holds a large amount of a digital commodity, it begins to resemble an investment vehicle rather than an operating business. I understand that perspective, but Bitcoin treasury companies have real operations, real customers, employees, products, revenue, and GAAP operating income. They do not meet the legal or economic definition of an investment company. The only reason Bitcoin has grown to represent such a large percentage of their balance sheet is because the Treasury strategy succeeded. Strategy itself is up over 1,000% since adopting a Bitcoin treasury. Bitcoin is long-term savings technology, so these companies that adopt this strategy and save Bitcoin for multiple years have been rewarded. It is also important to recognize that this 50% threshold is arbitrary. There is no financial theory, regulatory framework, or academic foundation that supports using this cutoff. It is not tied to volatility contribution, operating income, sector classification, or balance sheet risk. Adopting an arbitrary rule would allow subjective judgments that do not reflect how markets actually value companies. Many Bitcoin treasury companies also use Bitcoin as their hurdle rate for capital allocation. Bitcoin appreciates faster than almost any other asset, so most real investments do not clear that hurdle today. As a result, these companies naturally accumulate large treasury positions because it is rational to save in the strongest monetary asset available. Over time, as the Bitcoin adoption curve matures and appreciation rates moderate, this dynamic may evolve and companies may deploy capital more aggressively. A temporary imbalance between treasury assets and operating assets should not be the grounds for permanent index exclusion.
Digital asset treasury companies, otherwise known as DAT companies, like Saylor's company, had driven most of the buying in this cycle. MSCI is trying to classify Strategy as a fund now, not a company. And if that happens, Strategy gets kicked out of all major equity indices, which triggers forced selling from pension funds, retirement accounts, ETFs, etc. And I think that that's why the market dumped. Smart money probably repositioned before the ruling. Imagine this. It's like being kicked out of every group project because you were doing too well. I guess Saylor is just an overachiever. Maybe he's been Bitcoin's actual employee of the year this whole time and not Larry Fink. I think we got that wrong.
I just want to ask you about the JP Morgan report that came out this morning warning that Strategy could be excluded from benchmarks like NASDAQ, MSCI, and it could trigger an estimated $2.8 billion in automatic outflows. That's just from the MSCI alone. What's your response to that?
I think it's a bit alarmist. I'm not so sure the numbers are nearly that high. I think actually the numbers would be much smaller. I also think it's already priced into the market by a factor of 10 if you count it. I don't think there's any relationship between the decision-making of MSCI and the NASDAQ 100 or the S&P 500 index allocators. The company is an operating company. It's just like insurance companies use capital in order to create financial products, and banks use capital to create financial products. We use capital to create digital credit finance products. It's possible there are people in the world that don't fully appreciate digital credit or digital treasuries. That wouldn't surprise me. We had that challenge with bankers that didn't want to bank Bitcoin. We had that challenge with accountants that were a little bit skeptical of digital assets accounting. The accountants embraced the asset, the bankers embraced the asset, the politicians embraced the asset. We had the challenge with credit rating agencies, and they just embraced the asset. We're starting to get credit ratings. We have the challenge under the Basel Accords, where Basel Accords allocate zero value to Bitcoin, and now they've announced they're going to reconsider that. So I'm not concerned that we have these kind of concerns.
I love that he says there it's not that big of a deal. Saylor fires back. We're not a fund. We're an operating company building Bitcoin-backed financial innovations. He highlights his $500 million software business, $7.7 billion in digital credit instruments, new structured credit products like STRC, STRK, etc., all backed by Bitcoin. And these aren't altcoins. They're like corporate bonds for the Bitcoin era. He's not making Dogecoins. He's actually issuing regulated debt that's backed by Bitcoin. And apparently, Wall Street hates that. But what Wall Street hates more is stacking straight from the source and doing an end run around their whole system. Would you mine Bitcoin if it were as easy as buying it? Then you should check out Sazmining. It's not hosted mining, it's mining as a service that actually puts Bitcoiners first. You can own a state-of-the-art mining rig, plug into affordable carbon-free energy, and stack Bitcoin just like Satoshi. No middlemen, no markups, and no worries. Saz doesn't tack on extra fees when you sign up, and unlike other companies, there are no rig upcharges or inflated power rates. Their entire business model is based on a clean and simple revenue share. They only earn Bitcoin if you are too. A total alignment of incentives and 100% Bitcoiner values. While some claim simplicity, Sazmining proves it. Let's just say that if you need a compass to find your miners, you're not in the right place. This is how Bitcoin mining should have always been done. Visit sazmining.com or scan the QR code to learn more and start hashing. Okay, that protects your mining. Now, let's talk about protecting you. Check this out. This is my data broker report. 11 pages. They know every old address I've lived at, phone numbers, family members, what kind of car I drive. It's a little scary how much of your life these companies are collecting and selling without you ever saying yes. And here's the wild part. Scammers, spammers, even stalkers can just buy that info. Totally legal. And that's why today we're talking about Aura. Aura hunts down these data brokers selling your info, gets them to take it down, and keeps it off automatically. You don't have to go full off the grid Bitcoin mystic and live in a Faraday cage. Aura actually lets you keep your modern life and your privacy. They've packed it all in. Real-time dark web and fraud alerts, a secure VPN, antivirus, password manager, 24/7 US-based support, and $5 million in identity theft insurance if anything goes wrong. And the key? No other privacy service gives you this many tools for the same price. Try it free for 14 days at aura.com/simplybitcoin. That's enough time for Aura to start scrubbing your personal data off the internet without you lifting a finger. Look, protecting your Bitcoin is necessary, but protecting yourself? That's non-negotiable. Go to aura.com/simplybitcoin and take your privacy back.
I've always been deeply opposed to crypto, Bitcoin, etc. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case because it is somewhat anonymous, not fully, and because you can move money instantaneously, and because it doesn't go through, as you mentioned, all these systems have been built up over many years, know your customer, sanctions, OFAC, they can get bypass all of that. If I was the government, I'd close it down.
BlackRock, Fidelity, JP Morgan, all want paper Bitcoin control. Saylor, on the other hand, bought the real thing. Faster, bigger, and at lower prices. He's definitely paid his price of tuition. And now they're trying to ostracize him, not because he's reckless, but because he's winning. The ETF crowd wants to look like they're pro-Bitcoin as long as they're the ones controlling the rails. And let's be honest, we figured this out a minute ago. We were rooting for them, but then we remembered that they're evil as fuck. Saylor built a competing financial system, and they're jealous. It really is Mean Girls meets Wall Street. He bought more Bitcoin than the rest of them combined, and now they want to push him in front of a bus.
Oh! Do you know what everyone says about you? They say that you're a homeschooled jungle freak who's a less hot version of me. Yeah. So don't try to act so innocent. You can take that fake apology and shove it right up your hairy...
I swear that was the last Mean Girls reference. So let's go back to this amazing video by Joe Burnett where he talks about what this all means for Bitcoin.
Removing these companies would strip an entire category of corporate innovation from the investable universe and prevent passive investors from owning a strategy that the market clearly values. There's also a clear impact on the passive investors who rely on MSCI indexes for long-term investment. If Bitcoin continues to outperform most asset classes, removing the companies that capture that outperformance will cause the index tracking products to fall behind the true market. MSCI exists to provide neutral access to the full opportunity set that markets produce. Excluding high-performing companies because they hold a novel, unique, superior monetary asset creates an active bias, not a passive one. Most importantly, an index provider should not decide which monetary assets are acceptable for corporations to hold. Bitcoin is monetary savings for these companies. It plays the same role as cash or gold. Excluding companies because they hold a harder form of money is monetary discrimination. It punishes responsible treasury management and rewards companies that hold depreciating currency instead. This approach would also discourage corporate innovation. It implies companies should remain in weaker monetary assets to stay index eligible rather than adopt stronger balance sheet strategies. That is not healthy for markets or long-term capital allocation.
If MSCI wins, legacy finance locks Bitcoin behind walls, gates, and custodians. If Saylor's model survives, Bitcoin native finance starts to grow from within the system and eventually replaces it. Either way, January 15, 2026 is now a key date. Until then, the market may stay depressed, but the fundamentals are louder than ever. And before we wrap up the show, let's bring this home with a special message from our friends at Ledn. If you're stacking sats, you need Bitcoin-backed services you can trust. That's why we roll with Ledn, the global leader in Bitcoin-backed lending. Ledn has issued over $9 billion in loans since 2018 and a perfect record of protecting client assets. Why is a Ledn loan different? Collateral is not lent out to generate interest. No credit checks, funds in 24 hours, no monthly payments, repay whenever you want, zero penalties. And their proof of reserves, verified every 6 months, keeps them transparent. Ledn lets you unlock liquidity without selling. Sign up through Simply Bitcoin for 25 basis points off your first loan. Scan the QR code or click the link in the show notes below to get your discount today. Now let's wrap up the show. If they're this scared of one man with a Bitcoin balance sheet, imagine how scared they'll be when the whole world starts opting out of traditional finance. That's gonna actually be the battle of our lifetimes. Anyway, that's our show today. Let me know in the comments if you're on the side of freedom money. As always, remember to hit the like and subscribe, turn on your notifications, and share this show with your friends. It really helps us in the algorithms. Until next time, stack, slay, and stay bullish, baby.